Welcome, everybody. I'm Mark Peter Davis, managing partner of Interplay. I'm on a mission to help entrepreneurs advance society, and this podcast is definitively part of that effort. Today, we've got Phuong coming on, laying down a bunch of the fundraising options for really early stage companies. We're talking, how do you get first rounds of capital? Where do you go to begin with? How do you start? She lays out a good introduction to it. For those who are serious about this, I'd also recommend two more resources. I wrote an extremely boring book on raising venture capital about a dozen years ago. You can find it on Amazon. It's called The Fundraising Rules. And it's kind of like a handbook, so you shouldn't have to go through the pain of reading it end to end. Just flip to the chapter that's relevant at the time. The second thing we built is a company called Thunder. Thunder.vc is the website. And the idea of Thunder was to create a home for us to send all the entrepreneurs who we weren't going to invest in or we weren't going to incubate, but we wanted to help them find capital partnerships. And so we created this network where I want to say it's close to half the investment community that's actively investing in venture in the US is on the platform, VCs, angels, and the like. And you put in a lot of heuristics about your company, and it gives you very thoughtful matches. So it shows you who actually is a fit. Now, the beauty of this is not just it can help you figure out how to prioritize your time. There's a lot of investors out there that might not be on your radar. They might be in a different state, different geography, different network, different bubble than you're living in. And getting in touch with those people could be a win for everybody. So hopefully that helps take some friction out. You can check that out at thunder.vc. And with that, let's jump into conversation with Phuong and get some really helpful color on how to think about raising your initial capital.
So today I wanted to tackle a big question that can be really overwhelming for founders. And that's, once you've decided that you're ready or you need to raise money, how do you find investors for your startup? That's a question that we get asked often. And it's, I think for founders, once you're getting whether you're getting started or whether you're scaling, finding the right investors who can provide capital as well as other types of strategic value can really increase their chances of success. But I think for a lot of founders, they're often already working overtime on their regular day job of being a founder, and fundraising can be a full-time job. It could be, if you have co-founders, it's one person's full-time job. Today I wanted to kind of just break it down into some digestible parts. And hopefully our listeners can leave here with a game plan or with the beginnings of a game plan.
That's awesome. This will be hugely useful to a lot of people.
Yeah. So let's jump in. So, I think the way I wanted to go through it is like to kind of look at different buckets of investors and how, founders should be thinking about them and how they connect with them. So I think kind of that first segment is the easiest place to start looking, and probably the first place when you're first starting out is friends and family. These are people who already believe in you. They already know you, even if they don't totally understand your business. So, a good way of going about that methodically is just to go through your contact list and think about who might have the ability to invest. Maybe it's high net worth individuals. Maybe it's an aunt who's done well in real estate, or a friend's parent who already owns a successful business. I think the key here is to keep the list tight, but you want to raise money from at least 2 or 3 people. That way, no one person feels like they own you. But then on the other hand, there's not a bunch of people on your cap table. That's going to complicate things when you want to raise future rounds or when you're ready to sell. And I think at this point, it's really a good sign to investors to put in your own money, right? It shows investors that you're serious and that you believe in your own idea and in your team.
What happens if you feel guilty, right? You're calling your parents or your friend or your family members and, hey, I want to start this thing.
I think.
How do you handle that?
Yeah, I mean, that was something that I struggled with as well when I was a founder. And I think I found a good balance of people that I wasn't super, super close to. like not like my parents or my brothers that I felt like, and I would feel really, really bad. But people who kind of understood, other people who had invested in other businesses and kind of understood, what happens when you invest your money. It's not, always, it's not always a winning proposition. I think people who can be a little bit more hands off with their money, it was the approach that I took.
Yeah. And it's easier when that person is investing as part of a broader strategy of angel investing, because you're part of their portfolio. You do your best, but if it goes to zero, they've kind of accounted for that. If it's a family member and it's the only time they've ever written a check into a startup, you really want to make sure they size it appropriately. It should be a smaller check so it doesn't really affect their life if it doesn't go well.
Yeah, I think that's right. And then, so, once you've tapped out your inner circle, I think the next segment I wanted to talk about is angel investors. So these are people who invest their own money into early stage businesses like yours. So they're not, they're not investing on behalf of other people. A lot of times they may or may not be professional investors. And how do you find these people? I think the first thing to do is just to start local. Your city, your state, your alumni networks of your university or your grad school. There are a lot of city-based groups like Miami Angels, New York Angels. I spoke a few weeks ago at Gangels, which is which started in New York but now have chapters all over the country. These groups often host events where you can pitch directly to their members. So it's a great place to not only find funding, but also build relationships in the angel community. So I think to find groups like this, all my tools are great to use: Angel List, Investor Hunt. I think one thing I would say about these databases is that they're pretty big, and there's a lot of good stuff, and there's some stuff that's not so great. So you really need to do a bit of digging to find investors that are the right fit for you. And then I think the last thing I'd say about this, unless you want to add something.
I just want to throw in, and this is the kind of perfect entry point for tapping into Thunder, right? So Thunder, and people who've been following this for a while knows it's a platform built out of Interplay's Foundry, and we built it just for this reason, to help people figure out who to contact and how to navigate the ecosystem. And the idea is it's got a huge chunk of the angel and VC market on the platform. So we'll probably touch on it again with the VC side. But it does sophisticated matching. So it can help you, as Phuong said, when there's 800 results in a query, well, Thunder really only bubbles up the 35, 50 that are relevant.
Yeah, I think that's right. I think it's great to kind of balance more institutionalized, like methodical platforms like this. And then also, I would also say you just never know, right? Like who's going to become an investor or who knows who. So I think my other tip is to talk about your business everywhere to everyone. Angels aren't always traditional investors. A lot of times they're doctors or lawyers or other types of professionals that may not ever hear about your business unless you make the first move. So, just talk about it to everyone, and hopefully sometimes you'll just get connected by sheer luck.
What if you're worried that someone's going to steal your idea?
Oh, I think that, a lot of times these angel investors aren't founders, right? So I don't think that should be a concern. I think that, at Interplay, the way that we look at that is that, we work with a lot of startups, and our reputation is more important to us than anything. So we would never take an idea and run with it, because why would anyone ever work with us if we did? And I do think that a lot of investors and a lot of more institutional VCs kind of view it in the same way.
Yeah, I think it's something that a lot of people are really sensitive to, particularly on their first venture. There's some merit. I think generally the investment community likes to completely dismiss this emotion. If you're talking to someone who's a likely competitor, that's the time where you might want to zip it. But there's very few people who will match that profile, who are not busy with another project if they even are a founder. Right. And if they're not a founder, it's kind of not relevant.
Yeah, I think that's right. And then kind of moving on to the next bucket, this is a bucket that I have a lot of heart for, is to look at accelerators and incubators as options. So, these can be amazing resources for startups, programs like Y Combinator, Techstars, the Interplay Incubator. These programs not only give you funding, but they also give mentorship. And in our case, really kind of in-depth day-to-day mentorship, that we kind of think of ourselves as interim co-founder, where we're providing a lot of partnership, and also access to, our community, our network of investors, our network of experts that I think a lot of times are invaluable. These programs also help you refine your business model and your pitch. And some of them even end with demo days, so that allows you to pitch to other investors, and that gives you further exposure. So I think the value added by these programs can't ever be overestimated. And then outside of those, another segment that I think is often overlooked by founders are family offices. These are pretty powerful funding options. So family offices are wealth management firms for ultra high net worth families. So a lot of them invest directly into startups, especially if they align with the family's values and their investment goals. The only complication about them is they're usually pretty low profile. So they're harder to find than venture capital firms, right? So you really need to do some research. Platforms like Crunchbase or Family Office Exchange can help you identify these family offices. But they do require some legwork.
Yeah, they're hard to find. And so if you want to go that route, which is a terrific route for the right type of company, recommend you really consider the accelerator incubator path to get some partners who might already have some relationships, or take capital from one of the family offices that can open their network up and bring other groups to the table.
Yeah, I think that's great advice. Because I think a lot of these times these family offices, prefer a more personal approach, right? Like I think like a cold email to a family office probably isn't going to work as well as maybe to a VC. So relationship building here is key. And then outside, I didn't originally have this on my list, Mark. And when we talked earlier, you brought up the idea of non-dilutive capital options, which I think is a great way if you're a founder with a certain type of business, to really investigate. Are there specific options you would recommend that our audience look into?
I think if you have a SaaS business and you haven't raised money yet, there's revenue-based financing where you can borrow against future cash flows on the revenue side. Number of firms out there doing that are really wonderful, and used appropriately, it's a great product. Later in the venture game, there's venture debt, but for the stage of company we're talking about, it's not really applicable. And then the other one that doesn't usually apply, but every now and then does, and every now and then I see a company, maybe one out of a couple hundred, that shows up and has got some great leverage in it. If the company is building something that has some sort of national interest, either on the science or security or defense side, there's grants and government funding coming in. While the method for acquiring the funding might be a lot different than what it is to go through the private market, it's not necessarily harder and generally non-dilutive. So that can be the most attractive funding pool out there, but it's really niche and nuanced, and you got to kind of know how to tackle it. So there's people who specialize in that. And it really has to do with whether your company is something that the federal government really is excited about in their current mandate.
Yeah, and it's a lot of times it happens in tech or healthcare or science or like in companies that are benefiting the greater energy. I think a couple other, options to look at too are pitch competitions. I mean, these are a little bit harder to come by, but, TechCrunch Disrupt has a pitch competition, I think, where they give out, I think it's $10,000 to $50,000. MIT has a $100,000 entrepreneurship competition. Again, this is going to take some legwork, but it all does. Crowdfunding is another option. Kickstarter, if you have consumer facing products, Indiegogo, kind of similar to Kickstarter. So I would investigate. I think, depending on what kind of business you have, these could all be options that you look at. And then I left for last, venture capital. So, this is where the big checks come in. Now, before you start pitching to VCs, you need to make sure that your business is VC backable. And just in general, I mean, there are a lot of factors that VCs are looking for, but the big thing is to make sure that they're looking for big opportunities, right? So the market for your business needs to be massive, like $1 billion, billions in potential revenue. So once you kind of figure out whether or not you're VC backable, how do you find VCs? I think, start by researching firms that invest at your industry and at your stage. VCs have very specific mandates. Some of them are, only do seed or pre-seed funding. Others focus on Series A or even later than that. Some that also have very specific focus in terms of consumer versus, tech versus B2B SaaS. So look at their portfolios, see what they've invested in. If they've invested in startups similar to yours, then that's a good sign. Again, platforms like Crunchbase and AngelList are great for researching VCs. PitchBook, if you have access to that. Attend pitch competitions and events. Conferences again like TechCrunch Disrupt, New York Tech Week, often filled with VCs looking to connect with founders. And then kind of lastly, I'd say on that is, try to get warm intros, to VCs. Like look through your LinkedIn. If you have a mentor or an advisor or a fellow founder, if someone can introduce you to the VC, your chances of getting a meeting really go way up. Anything else to add to that, Mark?
Yeah, if people go down this pathway, they should check out the book I wrote a dozen years ago on raising venture capital. But one of the key takeaways there is this last pathway is really only relevant to a small percentage of startups. It's not a fit for most. And so before you spend a lot of time, as Phuong said, really make sure it's a fit.
Yeah, I think that's right. Yeah, I think it's, it's really a lifestyle commitment if you are taking VC money, aside from, actually having a VC backable business, as well as, some commitments to growth that you may or may not, want to do for your business. So it takes a lot of thought. I think regardless of, where you go looking for money, I think one thing I can't stress enough is that you should start building relationships with investors early, right? Even if you're not ready to raise money yet, connect with them now. Start sharing updates about your progress so they can see what you've been doing over time. Don't just start engaging when you're desperate or when you absolutely need the money, because, people can see that. So, I think, just in closing out, I think finding investors can be a grind, right? It's about persistence. It's about strategy. There's no clear, there's no clear plan that works every time. So you have to figure some of it out on your own, but start small with your friends and family and then branch out to angels and to VCs, as you grow. And then I think lastly, it's not just about the money. So keep that in mind. I think the best investors will bring advice, connections, and experience. That's really going to help you a lot. So it's really important who you choose to work with.
Wonderful topic. Very important for everyone. Thank you, Phuong.
Yeah, thanks so much.
All right, Phuong. Thank you. Awesome as always. Hopefully that was helpful to folks who are just figuring out their first steps here on the fundraising side. The short answer here is there is not a one size fits all. There's a lot of options on the menu, but only a couple are going to be relevant to the specific opportunity of your business. So very, very important to spend some time really diagnosing what kind of company you're building and where it fits in the capital market. Hope that helps, and we'll catch you next time.